In this video, we'll be looking at Unit 4E and income taxes. And, so there are a lot of different types of taxes that we come across: sales tax, gas tax, property tax. And, however, for most Americans, the largest tax burden comes from federal taxes on wages and income. And this is a place of huge contention in politics, and just recently a huge tax overhaul was passed in Congress, and so this can be a little bit of a touchy subject. And I love these quotes, and so I wanted to share them with you from the text. So first, from Ben Franklin: "In this world, nothing is certain but death and taxes." Okay, taxes aren't going anywhere soon. And this one is a pretty powerful quote by Albert Einstein: "The hardest thing in the world to understand is the income tax." And if you think about all of the difficult things that Albert Einstein says, for him to say the hardest thing is pretty profound. So we are going to stick to the basics of income taxes in this lesson. We are not going to go deeply. And it is very possible that no one fully understands federal income taxes, because the tax code is thousands of pages long, and it changes almost every year as new laws are enacted. However, there are some basic ideas behind federal income taxes that are relatively simple, and some of the harder rules apply only to a relatively small segment of the population. And so again, in this one, we are going to be talking about the basics of this. So before we get into this figure 4.13, to summarize how you kind of look at some of the basics in income tax calculations, we're going to go through some of the processes, some of the vocabulary here. So the process begins with what's called your gross income. Okay, this is all your income for the year, which includes any wages or earnings. Like if you work for a job that pays $10 an hour, those are your earnings, your wages. Okay, any tips if you work in a business and you make profits, interest from an account, dividends from stocks or other investments. Basically any income that you receive is your gross income. And there's another one that doesn't come into account, but you'll also hear net income, and that's what happens when they peel off all your taxes and things. And that's your take home, is your net. But anyway. Now, there are some gross incomes that are not taxed in the year that it's received, such as individual retirement plans, which are IRAs. And there are some other tax-deferred saving plans that are out there that aren't taxed that same year, but taxed at a later time. So these untaxed portions of your gross income are called adjustments. So when we subtract adjustments from your gross income, we get your adjusted gross income. From there, we have from our adjusted gross income, most people are entitled to exemptions and deductions. These amounts are subtracted from your adjusted gross income before your taxes are calculated. So once you've got your adjusted gross income, you subtract exemptions and deductions, and then you are left with your taxable income. Okay, and then once you have your taxable income, we can go through some marginal tax brackets and calculate how much you owe in tax. And so we're going to be going through that. Again, the tax table or tax rate computations based off of your taxable income. And once we calculate that number, you may not actually have to pay that much in tax if you are entitled to what are called tax credits, such as child tax credits that many parents can claim. And tax credits are nice because once you calculate your tax credits, they're subtracted right off of your total tax. So they're not, a tax credit is not an exemption or a deduction. It actually comes right off of your tax, basically the amount of taxes that you should owe based off of your taxable income. The tax credits after that, you subtract those off of that, and so they're pretty nice. So Now, most people already pay part of their tax bill during the year using what's called withholding, and that's where the federal government will withhold a certain amount of your paycheck and put it towards your tax bill, so that you're paying a little bit throughout the year rather than all at the end. Some people do pay estimated tax, especially for those who are self-employed. And so at the end of the year, you find out how much you owe in taxes, you subtract what's already been withheld, and if you ended up paying more than you owe throughout the year, that's when you get a tax refund. So those are some of the general ideas of taxes. And here's how we're going to be calculating our taxes. So we start with your gross income, and then from there we're going to minus any adjustments to that income to get our adjusted gross income. So that's our first step, is we're going to find our adjusted gross income by subtracting any of those adjustments that we talked about, IRA, tax deferred plans, etc. Then once you've got your adjusted gross income, you're going to minus deductions and exemptions, and that will equal your taxable income. Okay, and then we've got to go to tax computation based on rates or tables, and I will show you this a little bit later on, and you get your how much you owe in taxes. From there you minus your tax credit, and that will be your total tax that you owe for the year. Then once you know your total tax, you're going to minus any payments or withholdings you have, and then that will finally tell you how much you owe or how much of a refund you are going to get. So that is kind of the flow chart of how you go through taxes. Now, when you pay taxes, some of it is very dependent upon the status that you are. We call that the filing status, such as if you're married or if you're single. So most people fall into one of the four following categories. You're either single, married filing jointly, married but filing separately, and then if you're a head of household. And you can see the what all of those mean there. You can read through those. So let's do a couple of questions now that we've got all of those definitions in here. So we want to find the gross income, the adjusted gross income, and the taxable income for the following individuals. So we have Antonio earned wages of $47,200. He received $2,400 in interest from a savings account, and he contributed $3,500 to a tax-deferred retirement plan. And so from there, we're going to stop there, and we're going to get the gross income. Okay, the gross income is going to be his wages, so $47,200 plus the interest that he earned in that savings account, so $49,600 is his adjusted gross income, or excuse me, his gross income. That's before we make any adjustments, before we subtract anything off. Then we have to find our adjusted gross income. So we're going to take that gross income, $49,600, and we're going to subtract off. He had the $3,500 that he put towards a tax-deferred retirement plan. So his adjusted gross income, we're going to subtract off that adjustment of $3,500. Again, that would be taxed at a later time, so it's deferred or taxed for a later date. So when we subtract that, we get $46,100. That's the adjusted gross income for this individual, Antonio. Okay, now the last part says he was entitled to a personal exemption of $4,050, and he took what we call the standard deduction of $6,350. And we'll talk a little bit more about these exemptions and deductions here in a moment. But just remember that when we're finding the taxable income, we subtract off those exemptions and deductions. So the taxable income is going to be the adjusted gross income, $46,100, minus the exemption of $40.50 minus the standard deduction of $63.50, and once we subtract all that out, we get $35,700, and that's the taxable income that we would be making the calculations on for Antonio to find out how much he owes in taxes. So that's how you'd find gross income, adjusted gross income, and taxable income when you're given that bit of information. So now let's look at this idea of exemptions and deductions. We'll just be brief here. A lot of this information is going to be given to you. So again, exemptions and deductions are subtracted from your adjustable gross income, but they are calculated differently, and that's why they have different names. So exemptions are a fixed amount per person. So $4,050 in 2017 for most people. Okay, you can claim an exemption for yourself and each of your dependents. So for example, I'm a parent, so all of my children, I have 4 children, I am able to claim them as an exemption on my taxes. And so they apply to my taxable income when I'm finding that out. Now, deductions vary from one person to another. The most common deductions include, and this has actually changed just recently in tax code, so what we're telling you here is still relatively true, but there are still some adjustments, and that's why we say income taxes are one of the most difficult things because it's so long and it's ever changing. But some of the most common deductions people have are the interest they pay on their home mortgages, contributions they make to charities, and taxes that you have paid to other agencies such as your state income taxes, local property taxes. However, you don't necessarily have to add up all your deductions. When you file your taxes, you have a couple of different options, and you only want to choose the larger one since it's going to reduce your taxes more. So you can choose the standard deduction, which is the amount that is dependent upon your filing status, and we'll see that here in a moment. Or you can itemize, and itemize is where you add up all those individual deductions we talked about before, which are your mortgage, contributions to charity, taxes paid to other agencies, etc. But note that you either get one or the other. So you either get standard deductions or the itemized deduction, but not both. You always want to take the bigger of the two. And so most likely for you guys watching this video, if you're early on in your earnings, you're going to take the standard deduction because you don't have a lot to itemize. But as you get more into careers and things, itemizing becomes more and more prevalent amongst those people. But okay, now usually these things are relatively easy to calculate, but there are some complications when it comes to our higher income taxpayers, because there are different thresholds and things. So you can look down here. There's what's called an alternative minimum tax. There are some things in here that get a little bit cumbersome. We will not cover that in this lesson, but just know that there are other deductions and things in here. But again, they're usually for a small portion of the population, and we will not be covering them. So here we will ignore these computations in this chapter. And let me just check and see how we're doing on time. Alright, so we're out of time for this video, but we will continue Unit 4E in Part 2.